Well, thank you very much for that introduction. Um, Let me begin by saying that I was asked if I would speak generally on investing in precious metals mining companies, with a bit of an emphasis on our company, Yamana Gold. But in that context, I am asking myself today, why am I doing this in the midst of a world that is awash in crypto this and crypto that, with robust stock markets, with cheap money everywhere? Why would I want to talk about an apparently boring yesterday's news topic, such as investing in gold stocks? And to be clear, I'm not here to talk about investing in gold, not the metal, although that plays some part in investing in the companies that mine for and produce gold, or any precious metal for that matter. And if I were Henny Penny, I would be screaming at the top of my lungs that the sky is falling, that there is an inevitable broader market correction. It's just a matter of time to when and by how much. And most of you would not believe me because the sky seems perfectly normal and everything invariably will continue to go up and up and up and up. And equally, unlike Henny Penny, the sky is falling and the broader market will correct. Unquestionably, gold stocks, at least the sector for gold stocks, is unloved today, in part because of the broader market doing so well, but also because the cool factor of other sectors like crypto has become more in vogue. In addition, gold investing has become easier, and that makes investing in gold stocks, in some respects, less relevant. What once was a way to invest in gold through the companies that produce it has become less relevant, as ETFs for gold, for example, have become more common. So I'm here to make the case that this is about to change, and why my sector, in such disfavor, will become in favor again and sooner than people think. And to start, let me begin by thanking you for being here in person and virtually. And I am disappointed not to be there in person. It has become tiresome to do all of this virtually. We are at the point of disbelief that humans have bodies and form and are actually bigger than the 16 by 9-inch screens on which we normally present ourselves, or whatever size computer screen we're on. I regret that another variant has introduced new restrictions that make travel challenging, but I hope that all of you remain safe. Now, as I am admittedly a shameless promoter of our company, please indulge me as I go through my thesis on gold investing and show examples that include Yamana Gold. So begin some questions to ponder. Why invest in gold? And is investing in a company that produces gold a better investment than the metal itself? What about other newer asset classes that some say are alternatives to gold? Ultimately, these are the lead-ins to this question. How should an investor gain and maintain exposure in the gold space? And is that a good place to invest? So let's begin with gold equities as a sector and the opportunity that presents itself for investors today. A word of caution. I believe this opportunity will not last for long. And in my opinion, now is the time to get in. The gold mining sector is small compared to other industries. To give you proportion, take the market capitalization of the 15 largest North American gold producers and to match the size of, say, a company like Apple, the phone maker and owner of the App Store, we would have to multiply that cumulative market capitalization by over 13 times for the same market capitalization of Apple. That's tiny. And as a negative, the sector runs the risk of lacking relevance, doesn't it? However, there is a positive. And when it becomes relevant, and it will, the volume of investing, it will be disproportional to the size of the market. The zone will be flooded. It will be a volume of investing that will equal a Niagara Falls volume of water through your garden hose. And as we have seen this before, but in this cycle, gold companies have become more disciplined in their growth, capital allocation, and capital returns to investors. They are better focused. They are paying attention to health, safety, environmental, and community matters. And the valuations are better than in prior cycles. Investor portfolios are underweight in gold companies, and valuations assume an almost imminent gold price decline, which will not occur. And as such, gold equities are currently pricing in a worst-case scenario, which, in my opinion, will not occur. And unlike the Henny Penny story, for this sector, the sky is not falling, and more interestingly, gold equities are trading already as if gold is deeply discounted. And the rest, as you can appreciate, is upside. Now, we can see this worst case scenario by comparison comparing gold companies again to other sectors. And to use an example that illustrates an extreme disparity, let's compare again the top 50 North American gold companies with technology companies. Investors have piled in overweight on tech companies, and you can see that both in size, but also in valuations. The average of the North American gold sector is trading at a substantial discount. As compared to Apple, once again in my example, the average for both enterprise value to EBITDA and price to cash flow is at more than 70%. And against today's current economic backdrop, this is not sustainable and cannot continue. So far, investors remain underweight our sector. But in past cycles, when investors do begin to rotate capital into gold equities, multiples significantly increase. This time won't be any different, and we will be in for a sustained period of strong share price performance while the industry maintains discipline, remains committed to safety, health, environmental, and community management principles, continues to demonstrate sustainability of production with long life assets and mine extensions, remains consistent, continues to encourage openness and transparency to demonstrate mining friendliness, shows financial resilience, and continues to pay strong shareholder cash returns. So at this stage in the cycle, how one should position their investments? Is it better to invest in gold or gold equities? And what about other asset classes claimed by some to be alternatives, such as crypto assets? Let me start with the crypto assets. To begin, crypto assets are not digital versions of gold or replacements for gold. The comparison isn't even close. Gold and crypto assets are different asset classes, and they trade on different factors. And please note, a bias of mine, that I refuse to refer to this asset class as currency because it is not. It is an investment asset class, which is perfectly fine, but referring to it as currency elevates it beyond its status. The demand for gold is much broader and includes demand from central banks, jewelry, and technology, in addition to demand from investments. Crypto assets demand remains largely, almost exclusively, from speculative investment. Crypto assets have seen strong returns in recent years, but also bring about heightened volatility to an investment portfolio, which increases risk. The regulatory framework is also a key differentiator between gold and crypto assets, with regulation evolving in a number of countries, which potentially adds further volatility to an already volatile asset class. And what exactly is the environmental footprint of crypto assets, and how badly does it compare to gold and gold companies? We can, as an industry, get to net zero on emissions, and in my view, they can only dream of it so far. So while these are a few brief points, they highlight the differences between gold and crypto assets and demonstrate that it is flawed to believe that one is a substitute for the other, or that the market is not large enough to support both. Without substitutes, gold should become an important component of investment portfolios. But the question remains, what's the best way to gain gold exposure? This is where the rubber hits the road. And here's my position. While gold investing is respectable, investing in gold producing companies is an excellent way to get portfolio torque. Investing in gold companies is the better investment and the best way to gain exposure to stable and then rising gold prices. So while gold investing is good, the reasons why gold stocks are better include, first, valuations, which remain attractive when compared against not just metal price, but also when compared to equity valuations of other sectors. And gold companies are delivering strong cash flows, increasing returns further through the deployment of more capital to high return opportunities. Gold companies can and do pay dividends, providing a cash return to shareholders. They can also execute on share buyback programs to provide growth on a per share basis. And both of these opportunities provide attractive cash returns, which will increase with the higher cash flows that are generated. Dividends also serve as a way to compensate for inherent operational risk with gold companies that is not found in investing in gold. There is optionality to investing in gold companies that you don't get when you invest in gold. With gold price increases, gold companies generate further returns above the returns from just investing in gold alone. And all of this leads to something that has been forgotten, which is called the multiplier effect. More resources, more production, or both, multiplied by higher gold prices, leading to more cash flow and increasing enterprise values and net asset values. A purchase of physical gold in the form of a gold coin or a gold bar, or any unit of gold, or some instrument that represents a unit of gold is immutable, although the value of that unit is entirely dependent on the price of gold. If the price rises, you gain the benefit of the difference. End of story. On the other hand, let's take a look at gold mining companies. A share of a gold mining company brings the value of the gold currently in the ground or being produced, plus the value of any increases in resources or production, times the higher gold prices. And this is a very powerful catalyst when the gold price is high and rising. That multiplier effect, derived from higher gold prices at the increased level of in-ground resources or production or both, can create significant positive swings in the value in that it multiplies the higher gold price not only by the original level of resources or production, but also by the increases in resources and production. This positive whiplash can be quite significant. Let's look no further than our Jacobina mine to see how this can play out. In February of 2019, we forecast annual gold production of 145,000 ounces from that operation. At the time, gold was trading just above $1,300 per ounce. We later raised our guidance to 152,000 ounces, which Jacobina exceeded, producing that year 159,000 ounces. By then, the price of gold had climbed to just over $1,500 per ounce, so the value of that operation was not only lifted by the 16% increase in the price of gold, but also by the 10% increase in production. And this multiplier effect is only accelerated in the interim, with gold prices continuing their ascent and Jacobina increasing its 2020 production guidance to a range from 162,000 ounces to 168,000 ounces. But let's go further back just to highlight my point. In 2014, Jacobina was producing roughly 80,000 ounces per year, with a gold price that was just over $1,250 per ounce. Mine life has increased in the meantime, which is really significant considering it applies to a larger production platform, production that is now approximately 170,000 ounces per year. Is it a wonder that the net asset value for that operation has gone from $545 million at the time to just over $1.5 billion today? That is a full 186% increase, while gold prices increased only 48% in the same period of time. Ergo, the multiplier effect. Now, another benefit of gold companies is yield. Physical gold, as you are aware, does not pay a dividend or any form of cash return, but many gold mining companies do. We certainly do. With a high and increasing gold price, when cash flows and cash balances are on the rise, gold mining companies are more likely to increase dividends. And this is certainly true for us, as we have raised our dividend 3 times in the past 12 months alone for a cumulative increase of 210%. And since early 2007, when we first began paying a dividend, we have paid almost $1.1 billion in dividends, which places Yamana amongst the best in class of gold companies and certainly demonstrates that we punch above our size and weight class. And to be sure, investing in gold companies is riskier than investing in physical gold. As I said, gold companies do come with operational risk, whereas the only risk for investing in physical gold is price. And dividend yield should be seen as a part of a way to compensate for that assumed risk. So the question to ask is, does one get a sufficient reward with cash returns when investing in gold companies? And I think it's clear where I stand on this. There is still time to capture the early stages of this cycle as companies pay handsome dividends as yield to share price. And while I acknowledge my bias, when investors choose to allocate capital to gold companies, they should choose Yamana with its high-quality asset portfolio in high-quality regions and mining-friendly jurisdictions, a track record of delivering on production, costs, cash flow, and dividends, and health, safety, and environmental and community relations goals, and strong balance sheet, organic growth prospects, and rising cash flows. Accepting that gold companies are the better way to gain exposure to gold leads us to the value proposition that is presented in investing in our company, Yamana Gold. And that takes us to royalty companies. Royalty companies have traded at substantially higher multiples than gold producing companies for the better part of the last decade. And some say that that is with some justification. Royalty and streaming companies don't shoulder the cost of developing, operating mines. Their business model involves purchasing the right to a mine's present and future production for an upfront payment at a fixed price per ounce of metal delivered. As these companies do not operate mines, their overhead costs are lower, and because their royalty and streaming agreements are set at a fixed price, their margins and cash flows are secure, even if the price of gold is relatively low or declining, as was the case for the better part of the last decade. Normally, royalty or streaming arrangements can secure upside in that increasing mine life or production is not capped. But I strongly argue that these companies never deserve their lofty valuations, particularly as compared to more miserly valuations afforded to producing companies. And I argue that the optionality that is embedded in every gold investment can't exclusively flow to the benefit of royalty and stream companies at the expense of producing companies, even at low gold prices. Now, admittedly, royalty and stream companies don't attract the same sort of operational risk that is inherent into a producing company, but the risk is not altogether removed. I also strongly argue that royalty and streaming companies were given far more benefit of the doubt than was reserved, all at the expense of producing companies. But we're no longer in a low or depressed gold price world, are we? With a high and rising gold price, the calculus begins to shift. While margins and cash flows of royalty companies continue to grow as gold price increases, leverage to gold price decreases given their low fixed operating costs. And conversely, margins and cash flows of producing companies expand at much higher rates relative to their inherently higher operating costs, setting the stage for explosive growth in cash flows and valuations. Let me give you an example in the case of Yamana. Every $100 per ounce increase in the price of gold represents an increase in annual EBITDA of $100 as well as a $70 million increase in cash flows. So given this backdrop, a higher weighting in gold mining companies relative to royalty companies makes sense because the multiple applied to the higher cash flows in the producing companies in the current gold price world creates an explosive increase in value. Moreover, for many producing companies, which have been trading at weak multiples and valuations that are not yet reflecting gold price, the multiples and valuations will improve as market participants play catch up. And now there's another factor working against royalty companies with higher gold prices. We should assume that the higher multiples at which they trade also reflects the prospects for growth from investment opportunities. Will there be as many investment opportunities with a rising or high gold price, or will royalty companies experience a relative dearth of those investment opportunities? We can assume that some of the premium was based on the growth prospects, the universe of available candidates who needed to engage with royalty companies in what was a weaker gold price world. We should expect that changes when there are more options available to producing companies. Issue of equity, issue of debt that can be financed by cash flows, or cash flows alone that can finance the business. Now, that doesn't mean that one shouldn't consider an investment in royalty companies. We should, but royalty companies offer diversity across mining assets and steady returns. But when it comes to the percentage weighting in a portfolio, we should recalibrate with high and rising gold prices to maximize the benefit from the explosive margins and cash flow that comes from gold mining companies. So here's the shameful but necessary promotional part. Yamana is trading at attractive valuation levels as compared to both peers and to prior historic levels, and to companies in other sectors. The company is delivering strong and increasing cash flows, translating to increasing financial flexibility, adding further cash to a fully financed growth profile. And we have impressive growth both in resources and in production, and also in cash flows. With increased cash flows, dividends have been growing and further capital returns have been made available through share repurchases. The company has an admirable health and safety and environmental and community engagement track record. The company remains well positioned to provide investors with optionality to outperform the returns from investing in gold and realizing the multiplier effect through increasing gold inventory, production, and cash flows. And with that, just for a moment, I'll come back to gold price. And several notable people in the gold mining industry have told me over the years that anyone who claims that they can predict the price of gold is either a fool or a liar. And generally, I agree. But with the utmost respect to those persons, there are some nuances that need to be considered. You can predict direction, you can certainly predict indications, and there are times when you can be bold and say, this is where I think gold price will go. Gold is trading at approximately $1,800 per ounce. It's up roughly 17% in the past 24 months. Can it hold at these levels? And is there more room to run? And I believe the answer is yes and yes. Many of the factors that are positively affecting the price of gold are in place. Low interest rates globally, elevated debt levels, easy monetary policies, central bank buying, ongoing trade tensions, and worldwide political and economic dislocations and distortions. COVID-19 has accelerated what was already happening, and once again, punctuates our uncertain times. And since the pandemic began, central banks have been expanding their balance sheets at astounding rates, and which continues. And this is true for fiscal support from governments also. G20 economies have so far provided fiscal support totaling more than $17 trillion and increasing. And this is unprecedented. These initial fiscal stimulus measures are already higher than the entire spending that took place over multiple years during the financial crisis of 2008. And in addition, an increasing number of companies have shifted to negative interest rates, and total global negative yield debt has seen a substantial increase. It's fine for companies to borrow at low interest rates, but at some point, that debt needs to be repaid or refinanced, or a default occurs, or something else has to happen. And fiscal stimulus and government debt has pushed gold prices to all-time highs in a number of currencies and strengthened demand for gold-backed ETFs. And yet the price of gold is not fully reflecting what has transpired and the coming worldwide financial strains. Gold stocks are even more inappropriately priced. And there are three core reasons, as I conclude my presentation, for higher gold prices in the short to intermediate term. One, real interest rates are likely to remain low for some time, supporting investment demand in gold. In addition, demand in emerging markets will likely increase as these markets return to some sense of normalcy. In my view, that demand has not dissipated. It has simply been suppressed for a while. Secondly, there are factors that strongly support higher for longer inflation. I believe it will be in a long-lasting supply disruptions that, even with weaker overall demand, will cause an imbalance in favor of demand that will be inflationary. However, overall demand after 2 years of constraints is increasing. And finally, we come to the debt issue. The political objective of stimulus for longer is funded by deficits, and that has led to unprecedented debt levels. In my view, uncertainty and volatility of inflation, more than the inflation level itself, plays a big part in gold prices. Inflation is now underpinned by many factors, including debt-funded stimulus and market distortions. Where will inflation go? I think certainly higher, and without certainty, not sure where. In the 1970s, when gold price had its most explosive growth in price, inflation went from 12% to 5% to 14% in that period. And while I can't say that there is causation, it is informative that gold price went to its all-time high, which in today's dollars would be valued at roughly $2,700. Ladies and gentlemen, thank you for listening into this presentation. And as someone asked me earlier, I hope it is informative. I hope it has been informative. And I regret not being there in person, but look forward to seeing you next time.